Unfortunately, in India, culturally, we do not talk about money very easily, right? It's sort of a taboo topic. Okay, I bought some cryptocurrency, I did this and I made something, but that's not really money. Money is okay, I have a budget, I have a plan, I'm secure, I've discussed this with my spouse, we as a family know what we can afford. So, wellness for me is obviously, as I said, emotion, the mental status, the physical status of all your money, and emotional status. That I made my smart choices. Don't get uncomfortable with some friend of yours suddenly going and buying 2 shares and they're doing wonderfully well. But remember, they might have bought 5 others which are tanked and they'll never talk about it. So the example I give in Facebook, right? I mean, somebody told me I'm using Facebook for lending or something. I said, yeah, have you ever seen somebody write in Facebook that my child came 6th in a 7-man race? No, they'll only talk about the person who came first. So social media and we only talk about our successes. We rarely talk about our failures. The same thing happens in money.
Hey listeners, welcome back to your favorite destination of amplifying inspiration. If you are a returning listener, thank you so much for coming back. And if you're a new one, thank you for giving your time and listening to this podcast, Inspire Someone Today. With me today is a wonderful gentleman who is scripting India towards wealth creation. It is none other than Atul Singhal, founder and CEO of Scripbox, who to their credit have a total asset under management in excess of 5,000 crores, have their presence in 2,500 cities in India, and Atul goes with 3 mantras that he shares, which is start early, stay long, it's never too late to start something new. Atul, it's a wonderful pleasure to have you on Inspire Someone Today. Thanks for joining me today.
Thank you so much, Srikanth, for having me on your show. And to all your listeners, yeah, I hope this can be an interesting conversation and you can take away something from this which inspires you to do at least one thing new starting now.
Absolutely. That's the motive of this podcast, is at least one thing that is inspiring enough for people to take on from this conversation. The last previous episodes, we have had quite a few of folks who have joined me, who have been entrepreneurs, who have been founders, who have made career transitions of being in a professional corporate world to entrepreneurship. Yours is a slightly unique and slightly different in that sense. It is also about a very interesting chemistry between you and the VCs. So you are an organization where you have co-founded it and also have a strong backing of some of the best of the names in the VC world. Let's start off with that particular piece of what's been your lessons learned so far as a founder CEO, and then what is it like working with the VCs?
So I'll take those as 2 very separate questions. One is about what works with the VCs and what's been our experience, and the other is lessons learned as a founder and CEO, and more as an entrepreneur, right? So 3, 4. I mean, I have these sort of standard things I say, which I believe in strongly. The first is always remember it takes longer, it costs more, right? All of this, typically we have this tremendous hurry to do things. But just being conscious that being realistic in your own expectations as you set out to do things, what you tell your VCs, what you tell your own employees, while being ambitious is very important, being realistic is equally important. The second is that, I mean, as an entrepreneur, and this is the whole VC world, without the VC, cash is king. There is nothing like having capital available to you to lay out your dreams. That combined with the statement, and I think this I give credit to the Book My Show founder, who once said that more people die of overeating than starvation. So while cash is king and you should respect capital, have enough to lay out your ambition, but never get overcapitalized because you will then go do things which you don't need to do. So some of the lessons as a founder is that, yeah, have patience, make sure you have enough capital to lay out your ambitions, don't get overcapitalized. That's on the financial side. In terms of the basic approach to entrepreneurship, and I think this is to everything in life, but more so in entrepreneurship, is courage of conviction combined with raw ambition, right? So here what I mean is that you have to believe in what you're doing. I mean, don't go do something because you're going to get funded for it. Don't go do something. I mean, I mentor quite a few startups, and the number who come to me And what I sort of say, I said, why do you want to be an entrepreneur? What is the real reason? Is it because there's glamorous and you are getting your name in the newspapers because somebody funded so much and you became a unicorn? Is it you something really passionate about? And being sure that whatever you're doing, you have tremendous amounts of courage of your conviction that this is the right thing to do, right? For the customer, for your employees, for your stakeholders. So that, and obviously, I'm assuming ethics and values are the bedrock of anything you do. But having serious courage in what you do, because it's a bumpy road, right? Whatever you do, a lot of things have to conspire for you to succeed. So having courage in what you're doing is important, and you have to have ambition, right? The last thing you want, and I'm not saying being crazy, but just being hungry all the time, and when wanting more for your customers, wanting more for your business, wanting more for your employees. So having scale, this is my personality, right? There are a lot of people who build lifestyle businesses, and a lot of respect to them, right? But that's your choice. But if you are setting out to change the world, if you are setting out to do something big, one lesson learned is having tremendous amounts of ambition is really important. Last one, I'll not bore you anymore, is the composition of your founding team and your early employees, right? So it's important that, it's very difficult. I've seen very rarely a standalone, go it alone founder finding tremendous success. So finding the right co-founding team, a good mix of technology, business. So all of you should bring obviously a lot of alignment around culture, a lot of alignment around purpose, but definitely very complementary skills in terms of technical ability also. Who's got a business mind, who's got a numbers mind, who's got a financial mind. Not that each of you will not do each other's roles, but having those and having very real clear ground rules on who will do what and whose decision on what matters, right? So if it's pricing, if it's product, if it's business model, if it's fundraise, while all of you as founders or the leading team will think together and find consensus, but decisions are important, right? So making sure you have a well-defined decision hierarchy. Since I'm at it, I'll tell you two more, right? So the fourth is have an exit plan. So what I mean by that is that be very clear. The reality is startups fail. The reality is the mortality rate in startups is high. And that's not because you're not good enough. Maybe the idea is before its time. Maybe you couldn't find the funding. Maybe the market was not ready. Maybe your product did not work. So don't beat yourself up, right? But have an exit plan. That these are my criteria. When I have so much money spent or when I have not did this, I will do something else, right? And I'll find courage of conviction around that. The last, as you build your business, right? There is this building a hotel and running a hotel are very different things. And one of the lessons as a CEO now is that while you build, we've been at it for 10 years. See, building a hotel requires skills of an architect, of a mason, a carpenter, a designer, deciding if you're going to do a business hotel or a luxury hotel, how many restaurants will you put in, what kind of cuisines will you serve there, right? Those are decisions to be taken. Then you go build the hotel, right? You're building the kitchen, you get in people who can get you the kitchen equipment, who can lay it out, what is best in class. You might have a chef giving you advice, but he's not cooking food. But running the hotel is very different. You have to cook the food, you have to get it out of the table, you have to serve it, you have to wait it, you need front office staff. So the skills you require to build the hotel and the skills you require to run the hotel are very different. And the balance of the two as you grow the business, you have to continue to build the hotel. It's not that the hotel is fully built, right? You might need to change decor, you might need to add more restaurants. I'm staying with the analogy. Obviously, there are different ways to describe this. So as a founder CEO, figuring out this balance between what skills do you need at what point in time and how, and then that comes to the loyalty competence debate, which says that, hey, I joined you and we were a small team, we did everything together. I really don't have such a large role in the emerging company. That's just reality, right? Because you probably are a very good mason or an architect, but I don't need one. I actually need a waiter, right? So this balance is some of the lessons as a founder CEO. Which for listeners, all I would say is be aware, be conscious, but be courageous. Go out there, believe in yourself, believe in the opportunity. Yeah, and it'll happen. And if it doesn't, do something. There is always a second chance.
There's always a second chance. That's a beautiful opening, Atul, out there. Called out some of very intricate points around ambition, courage, conviction. I love the analogy around build versus run. And to add to the mix is your entire VC dimension, right? So when the VCs come in, are there key KRAs that you'll be measured against? On one hand, you have this bold ambition, conviction, I want to do this. Now, VC, by virtue of putting in their money, they would have their own set of ideas. As a founder, CEO, as part of the starting team, how do you stay true to your vision and goals?
So I think at least my experience, and maybe I'm just lucky, all our investors have been absolutely supportive of what we're up. Right? They might have been disappointed times. They might have wanted us to go faster. And I think also comes with our own experience, right? Given that I'm now having had leadership roles of 15 years in corporate life, partly my personality. In Hindi, I say, मैं सुनता सबकी हूँ, करता अपनी हूँ. So I listen to everybody, but do my own thing. So I think being very clear in your expectation setting with your VC very beginning as to why you're doing what you're doing and what you expect to do, and then standing up for what you believe is the right path, right? Because ultimately, just remember, the VCs want you to succeed. They are on your side, right? Very rarely have I found, and I think unnecessarily the VCs have a bad reputation of changing direction. They don't. They might bring you perspectives of a different company. They might ask you, you're answerable for the capital they've deployed. But in terms of business direction, absolutely no. I'll give you an example. I mean, I'm a founder of two companies and CEO of both. We used to be one, a company called Probe Information, which is the largest information platform in India. It's called Probe 42. Every bank in India uses that. And originally, when we went to Axel to get us funded, our original idea was to build out an international business, right? India, KPO. And we pivoted and said, no, the opportunity lies in India. India is a really large opportunity, and they've stood by us. I mean, they've invested in us, they've stood by us, they held our hand. Scripbox, right? I mean, we had competition come in, change the entire market, make it into free, and very, very good competition. Paytm money, ET money, grow. They changed the dynamics of the market. We stuck true to our path of creating value for a long-term business, and our VCs have been supportive. So I think this is a myth that VCs will make you change direction. They will if you're not sure of yourself, right? If you're not convinced about what you're doing, obviously, then you're also looking for what to do. But I don't think capital comes with conditions. Capital comes with expectations. So as long as your expectation setting is fine and you're delivering against that, you should be fine. So I wouldn't be worried about raising VC capital as long as you know how to use it. So again, that my example of starvation versus overeating. So if you overeat and then you've got money lying around, people will say, do something with it. So
That's a very fair call. Capital comes with expectations, and on that, quite a lot of our listeners all want to be entrepreneurs, thinking about it, or existing entrepreneurs. For many of them, you did mention about having the balance in your starting team, in the founding team. Similar to that, what are the things that one need to look into when you have to identify investors or VCs? What are those one, two, three things that you consider critical before somebody goes on that journey of finding an investor or a VC?
again, depending on how why you need the money and how much money you need, obviously there are different people at different stages. Are you doing angel, seed stage, series A, pre-series A? Again, there are different markers for why you need money and how much you need. Don't raise the money for valuation. Right? So especially the early stages, don't get too stuck on the value. Because there is no VC who's unnecessarily going to take an extra share of your company. I find this argument quite fallacious when people tell me, no, they're asking for so much. I said, it doesn't matter. You also don't know the value of your company. Just because Flipkart got valued at $36 billion or somebody else became a unicorn doesn't mean you are one. You're just getting started. If somebody is ready to give you the money, take it. Take it with an open heart, right? Again, there are different stages. You can start with what they call fools, friends, and family as your first round, the angel round. So that there are very low expectations. There are a lot of expectations around trust, but start with a small amount, bootstrap it, get to a certain stage. That said, when you're looking at a VC, make sure that expectation setting. What is the VC looking for? Is he or she looking for a 100x return immediately? Are they looking for you to replicate a model from abroad here? And then what is your freedom? See, again, being an entrepreneur, I'm sure lots of your listeners will say beggars are not choosers. That's also true. But when you do take the money, being clear that why you're raising the money and what you expect the VC to do with your relationship with the venture capitalist, if you lay it out upfront, it helps a lot. So I would look for people who have a track record of supporting companies for long term. I would look for a track record of companies or strategic investors who can bring you access to markets or a network effect. I'd look for VCs who bring you brand value. Right? What happens is that if you are looking to build a sort of a multi-generation company and you will raise multiple rounds, the quality of your cap table matters, right? So all of those are rules, but there's no science in this. One thing I have to say is, at least my experience with all venture capitalists has been honorable, honest. It's a very mature industry. As much as you're chasing VCs, remember they're chasing you, right? It's their job to invest. Their KRA is successful investments. So as much as you worry that, hey, your KRA is a successful business, their KRA is exactly the same.
So, Atul, we are at a time and age where wellness is all around us: physical wellness, mental wellness, digital wellness, whatever it is. With you, I'll ask a different kind of wellness, which is financial wellness. Since you are at the heart and center of what is happening in your organization, in the industry, actually, two questions to that. One is, what is financial wellness and what is not financial wellness? And my second question is, in a space that is flooded with so many choices, so many organizations, how did you differentiate what Scriptbox is and how did you kind of play with the big boys?
I'm sure people are asking the question too, how do you play with the big boys like Scriptbox? But I'll let that one pass. But we are the big boys now. But I'll come to that, jokes apart. I'll answer the financial wellness part. So financial wellness or financial well-being is a combination of awareness. So you should know your goals, right? You should know what you want to achieve. And obviously it changes over time, right? Just understanding the basics of finance, of taxation. So we run a program called Money Skills, right? This is a pro bono program we run at all the corporates where we'll talk about tax planning, we'll talk about basic financial planning, we'll talk about why investing is important, difference between equity and mutual funds, or so just the different asset classes, asset allocation. So awareness is the first step towards wellness. If you don't know what it means to be well, financial wellness is, I think, three states. One is peace of mind. And peace of mind is that I know what I am doing with my money and I'm doing the right thing as far as I know. So our brand promise at Scriptbox is financial santushti, because you have to be comfortable with the amount of money you have and what you're doing with that money, whether it is you're earning 20 lakhs, 50 lakhs, 1 crore. Everybody has his own challenge. Some people have to put their children through college. Some might want to send them abroad. Some might want to have a retirement plan. Some might want a bigger house. So having our job as a wealth manager or wealth advisor, or as we call it, boatman Majdar, who's going to walk with you, we define financial wellness as comfort with what are you doing with your money. And very often you need an expert by your side because you don't know a lot of your biases. The second is having a plan about your money. So like my daughter just started her career 2 years ago, and I said, hey, first and foremost, if you're earning 100, 25% has to be invested, saved. Forget about invested. It has to be saved. You can't spend it. So post-tax, whatever is in your money, optimize your tax, put 25 aside. It's like a piggy bank. You can't touch it. Then you figure out what you want to do with that. You need first an emergency corpus, and COVID taught us that, right? You might lose your job, you might have a financial emergency. Second is about having a plan. Financial wellness is having a very well thought through, structured plan, creating an emergency corpus, putting aside enough money for your slightly one-time annual expenses, right? You want to take a holiday, you might want to upgrade your phone, you might want to buy a laptop, you might want to. So everybody has different stages. So putting enough money aside every month for these one-off larger ticket items. Thirdly is having enough money or some part of that money for your long-term ambition, which is going to be 7, 10 years, 20 years. And having a plan around this is financial wellness, that you know you are comfortable with the amount of money you have. You have a plan. The last part is executing that plan. This is, I think yesterday we tweeted this. We said that having financial goals without a plan is like having a bucket list, right? So you can have any goals, right? If you don't have a plan against it, then you've created a bucket list. So financial wellness for me is understanding your money, having a plan to work with it, and executing. Whether you're doing it at 10 lakhs or a crore or 10 crores, actually is where you are in your stage in life and what you have, right? If compared to how we compare ourselves to what our parents did and what we are doing and what our children will do, Obviously, there are different levels of wealth you will have. But financial wellness is being comfortable with your money. For that, knowing what to do with your money, what does money mean, and also having a very healthy relationship with money. Unfortunately, in India, culturally, we do not talk about money very easily, right? It's sort of a taboo topic. Okay, I bought some cryptocurrency, I did this, and I made something, but that's not really money. Money is okay. I have a budget, I have a plan, I'm secure. I've discussed this with my spouse. We as a family know what we can afford. So, wellness for me is obviously, as I said, the mental status, the physical status of all your money, and emotional status. That I made my smart choices. Don't get uncomfortable with some friend of yours suddenly going and buying 2 shares and they're doing wonderfully well. But remember, they might have bought 5 others which are tanked and they'll never talk about it. So the example I give in Facebook, right? I mean, somebody told me I'm using Facebook for lending or something. I said, yeah, have you ever seen somebody write in Facebook that my child came sixth in a 7-man race? No, they only talk about the person who came first. So social media and we only talk about our successes. We rarely talk about our failure. The same thing happens in money. So financial wellness also means not reacting to other people's successes or stated successes. I'm sorry I blabbered on, but that's the various aspects of financial wellness the way I see it.
I'll take you from the last bit of it, which you mentioned about we don't talk about some of the things that we generally need to. And one such thing, basis your observation, is what are some of the unconscious biases that you have seen in investing?
So I think there's a very beautiful Maruti ad. This guy comes and there's a big ship and he shows him all the gizmos and he says, "Kitna deti hai?" Right? Unfortunately, we are somehow wired only around that return number. And that's the least controllable number in your life. And hence, I say having a plan, having asset allocation, something in equity, something in fixed income, something in liquid, something in gold, hedging across all of these is really important. So, first bias is performance, right? Everybody's anchored on a random number. I mean, you'll read Eco Time saying Sensex destroys 2 lakh crores of people's wealth. It's paper wealth, yeah. Figure out, I mean, it also returns 3 lakh crores. I mean, if you look at the secular trend of the market over the last 20, 40 years, it's upwards, right? I mean, it'll have its blips, but don't panic. So, first is don't be chasing performance. Have a plan, stick to it, and it'll sort itself out. Second bias, figuring out or being swayed by these conversations or a beer or this thing, not talking about the plan, but talking about individual stocks. Right? I mean, as a wealth manager, the first question I get asked every time is, Atul, what about that stock? I said, I don't have any idea. They ask you, what happened to Sensex? That doesn't matter to me. My customers don't invest in that. They invest in a curated portfolio. So, not being swayed by daily movements, not being swayed, not chasing short term returns is the other bias. The third bias is this lack of understanding of gambling, speculation, investment. Because gambling is illegal in India, I forget about other Dream 11, etc. doing. So people treat the stock markets as a gamble, right? You'll go to a dinner party and you'll meet some friend because we are older. You'll meet their son, 25, 27 years old. I'm also into investing. And say, okay, what are you doing? No, I've got this 2 lakh rupees and I've been doing this short term trading, right? No, that's not investing. That's not wealth. Yeah, that is very good for some people, for stock trading, etc. But long term, so don't get caught into confusing all of this. Like crypto being a classic example. Right? You sort of the FOMO factor. If I combine, so chasing performance, FOMO, being influenced by other people's stated successes, doing things you don't understand. Like if you are learning swimming, you don't go jump in the deep end without a coach, right? I mean, one of the better investors in the world, Ramdev Agarwal, had said this in one of our webinars. He said, "Yeah, if you're learning to swim, find a coach and then start in the shallow end and then learn up, right? You don't go dive straight in and go and invest 5 lakhs into a short-term trading by." So yeah, those are biases. Don't and money management is a professional game. It's a long-term. If you look at Warren Buffett or I mean, it's attributed to Einstein, the seventh or eighth wonder of the world being the power of compounding. Let time be your friend. Let power of compounding be your friend. Don't get look chase short term returns. So there are biases. People FOMO, oh, crypto. Oh, that guy got better returns than me. Have you asked him for 10 years? Maybe 1 month, maybe 3 months. Hey, Atul, what is the best return you can give? I said, best return, then give a return your money to you. So that's the Those are the biases. I don't know. Yeah.
Good segue into a new segment that we are launching on Inspire Someone today is I have requested a couple of my listening audience to share their questions that I can ask you, Atul. And one such question that has come my way is this plethora of options and advice available for investing. Where to find the right answers and what are the pitfalls to watch out for is one question. And the second question is investing in US or outside of India markets. What's your view?
So I'll answer the question to the best of my ability. Obviously, it comes with the biases because I'm a founder of a player in the market. So let's not confuse transactions, investing, and wealth creation. They're very different things. Transacting is the ability to buy and sell something. So most platforms in India, if I'm talking and I'm now staying in the digital world or the online world. I'm not comparing, though 95 to 97% of the market is still offline with the banks and the IFAs, etc. Now, since your audience is more likely to be online and trying to do things on their own, I will give them the options in that. Though, as I said, very often you'll have an LIC policy, you'll have a ULIP, you'll have some stocks. So this, don't think about investing as only what you're doing in the stock market. Money is about all of these: your provident fund, your health insurance, your ELSS, some LIC policy you might have picked up, all of that together, and the house you own, all of that together constitutes your wealth. So you need to think about wealth holistically and find somebody who talks the same language as you, rather than only transaction platforms. So a lot of large number of players have appeared in India, which I think has made universal access to the markets available. So you can buy and sell very conveniently, zero brokerage, no brokerage, zero commissions. So a very e-commerce kind of mindset has made access to market democratic, has not made access to wealth management democratic, because wealth management is an expert. So when you are looking for advice, as you called it, advice has to be at your holistic family wealth level. Very often, as in India especially, I mean, obviously people have different views. You're thinking about money about you, your spouse, maybe your children. So thinking about wealth holistically is the first stage to seeking advice. Secondly, seek advice for the next 10, 20, 30 years for your multi-goal journey. Children's education, buying a house or upgrading your house or retirement, all of that together. Not that kitna deti hai. So that's not investment. Right? That's not advice. If you feel that you are extremely capable and you've read all the balance sheets of all the companies you're looking to invest in, you've done your analysis and you really truly understand the fundamentals of the company, the quality of the management, then please go ahead and transact in what you believe you should. But if you don't know that and don't have either the time or the inclination or the expertise, all three are really important. You need to spend time, you need to have the inclination, you need to have the expertise, right? Because that's what is being managed by on the other side. Right? Any fund manager, any wealth manager, if he's picking stock or if he's picking a security or if he's creating a plan, he's got all of these in his time, on his side. He's getting paid. So I would say that if you're thinking about long-term wealth creation, looking for advice, find an advisor, not a transacting platform. I mean, I saw a couple of websites which talked about flavor of the month or most popular stock today. Are you serious? Are you buying roti, sabji, dal? You are planning your financial future, right? It's not like you're following everybody else. Right? So that's the second part. In terms of international stock, that's my view that if you're looking for a good advisor, I'm a sales guy, come to Scripbox. I'm absolutely confident without any qualms, ethically, values driven, long term orientation that Scriptbox brings to its customers is going to be rare to find, right? And that's why I say our VCs are very kind to us. They're very patient. We've always said patient capital gets long term returns. A lot of respect, a lot of competition, but I would say a lot of them are just transacting platforms. So differentiate between those. In terms of international stock, yes, but a why. It's not the what, but the why. The how is obviously there are enough trading platforms to do. The why has got to be because it is part of your overall plan. So if it's a diversification outside your, say you've got 100 rupees to invest, you've decided that, hey, the five asset classes which meet my needs for various goals are 40% or 50% in equity, 30% in fixed income, 10% in gold, 10% in international equity, right? That view is more important than should I buy Amazon or should I buy Apple today? And that is a very late stage answer, right? So unfortunately, we get caught very quickly into what should I buy, but why are you buying it? How does it fit into your overall portfolio? What is the purpose? How will you decide to stay or exit? How will you rebalance your portfolios really, really?
Sorry, goes back to your earlier point of don't get swayed by what's happening around you.
Yes. So yes, we today advise our clients that at least 10 to 15% of your portfolio should be international. For customers saving up for children's education abroad, we've got a product called the Global Education Fund for their children. There we are saying 50% should be in international because you're dollar hedged, right? So it's all for purpose. If you're going to invest 10,000 rupees a month, it again of the quantum. I mean, you got 10 because we got customers from 5,000 rupees to 50 crores. Obviously, it's horses for courses. How does it fit into your plan? Should we do it or not? How much of your wealth should go into it? For how long? Then you get down to buying. Do you buy an index fund? Do you buy an ETF? Do you buy tech stocks? Do you buy FANG, as they call it, Facebook or Meta, Amazon, Apple? So those are all much later answers. So yes, at a certain portfolio size for a certain set of requirements, including international stocks as a diversification of your overall asset class is really, really important. But basis of that judgment call. And again, I would suggest that talk to somebody who knows.
And we'll definitely leave links to Scriptbox in the show notes so that people, if interested, can definitely go check it out. Okay, if you're ready, we'll get started with the power of three round.
Let's go for it.
Cool. Three trends emerging in the stock market.
Trends emerging. So I think nothing new emerges in the trend market. There is nothing we have not seen before. That said, in the investing category, crypto obviously is a new trend. So my first answer was there is nothing new as such. We've seen it all before. Crypto is a new trend, and we are seeing obviously, as I said, democratization of investing. So the number of demat accounts have opened up is absolutely massive. So a lot more people participating. So those are the three trends, and it's about making sure that we are able to combine the three, create a long-term orientation for these new entrants, so that invest for the long term would be a good answer for the country.
Okay, good one. Three lessons learned as a founder.
I repeat what I said in the beginning. It always takes longer. It always costs more. Cash is king. And third is, I think it's very important to remember that since it's a long-term game, very often it's like boxing with the clouds, right? So you'll have a really busy day. You'll go out, or even a week and a month, and at the end of it, you got nothing to show for it. Those things just take time, right? So don't get disheartened, don't get frustrated. So one lesson is that very often it's like boxing with the clouds. Right? You've put a lot of effort, and there's nothing to show for it. It happens to everybody.
If you had a choice of any three individuals mentoring you, who would those three individuals be?
Elon Musk for pure ambition combined with innovation. Probably somebody like Warren Buffett or Ben Graham on just the approach to investing, about long-term orientation or value investing. And somebody like a Charlie Chaplin with the ability to laugh at yourself, to not take yourself too seriously, have fun in whatever you do, have a sense of humor. So yeah, so that would be my sort of, and obviously I have my own mentors. I don't want to name them and embarrass them. But if I had global icons to look after, there would be that would be my combination of people I would love to learn from.
Three book recommendations that Atul can share with us.
So my favorite book, which I have sort of guided a lot of my life, is the Atticus Finch one, To Kill a Mockingbird. That is just so powerful in its simplicity of story about what to do. Little Prince, which is just the innocence, and because of the category I am in, Morgan Housel's The Psychology of Money. If you read these three books, it gives you a very different perspective. First book is all about ethics and doing the right thing and standing up for what is right. The little one is about childlike innocence and thinking about things and seeing them very differently. And the last one is about the psychology of money.
For many of the first-time investors, what would be your three advice be?
First time investors is this is not a short term game. This takes time and patience. So don't chase returns first. Secondly, make sure you're investing with a purpose. Why are you investing is important. Is it for, like I said, is it an emergency corpus? Put the money into liquid funds. Is it what you want to do in the next 2 years, 3 years? Buy a bike, buy a car. What do you want to do? Put that money aside in say debt funds, and then obviously plan long term for your retirement. So a lot of people say, but the power of compounding, putting 10,000 rupees aside. So we show this to people in a demo, right? There are two friends who start off, both are 25 years old. First guy invests 1 lakh a year for the first 10 years in the same amount. The second guy starts, no, I've got to spend money, I have to do things, I have to travel. He doesn't save anything. He starts at 36 and he invests, and both touch their corpuses when they're 60. The guy who invested only for the first 10 years and then stopped investing because he had children and other things. The other person started late and kept investing. So he's invested for 25 years, this person for 10 years and stopped. The person who invested for 10 years and stopped, the power of compounding is so strong that he'll have 3x the money on the other side. Just start early, right? Start early. The first time investors, don't wait. Just a horrible thing. Because you always know, today I'll go for a party. So first time investors, invest with a plan, start now, and keep investing. Keep investing.
Last of the power of three round, Atul. What are three unique practices that Atul practices?
Get up early. I don't know if it's unique. I get up early. Always have a to-do list, which I do. Just I have a structured way of. And as a leader, I mean, not as a, I'm reasonably decisive. Right? I will not let anything fester. So if you come to me for a decision, I will ask you the relevant question. Provided it's my decision to make. If it's your decision to make, I'll push it back on you. But one of the things you have to do is decide. Decide quickly. You might not get all your decisions right, but just courage of conviction that I'm doing this for the right reasons. Okay, go for it. So I think those are, compared to other people which I've seen. The reason I say I still see people getting up pretty late, my own children, not being very organized in your what is coming next, having a plan. Thirdly is sort of analysis paralysis. So avoid that. Have sufficient information to take a decision and take a decision.
Wonderful. Atul, thank you so much for being a sport in this power of three round.
Thank you.
Moving along, one of the pieces that you started your whole entrepreneurial journey is at the age of 43. Forbes did recognize you recently being one of the late starters, but having a impactful thing in the industry. What was those defining moments for you to make that transition of being in the corporate, getting into entrepreneurial journey at the age of 43?
I wouldn't say I'm genuinely what they call an accidental entrepreneur. Right? So I had come back to India in 2008 to actually set up a asset management company. We were applying for a SEBI license. We were setting up a wealth management business for a group in South Africa called Old Mutual. That is the reason I came back to India as a corporate manager. But Lehman Brothers happened, right? So we had to shut that down. So I was at a loose end. I could have gone back abroad, picked up a title, but I'd worked long enough to know that I would be doing more of the same. I'd have a different business card, I'd have a different designation, and now you'd hit that level of seniority that you'd be group product manager, global, one of those. It didn't excite me. I didn't feel I could get myself out of bed. It just so happened that Axel, which is also happens to be investors in our company, were open enough to allow me to spend some time in their ecosystem atmosphere as an EIR. And I realized this is something I could do. I was really excited about it. Right? And Flipkart just got funded. I'd spent time with the Bunsels. I had also looked at some other startups, some deals. I said, this looks like something, if you have the energy and the desire, you could do it. Start spending time, figured out a business which would make sense, which was Probe, because Ravi, who was my founder at the company, it was a little boutique equity research firm. I said, hey, if we get together, we can and find some funding, we can really build this out to be big. So we did that. As we were doing that, we saw companies like Betterment, Wealthfront, Motive sort of getting invested in or growing in the US. We said, hey, this looks like an interesting one. And given my background on the AMC license, digital businesses, Sanjeev, who's the other co-founder in technology, Ravi as a fund manager, we felt we could genuinely change how India managed their money. And that's how the idea of Scripbox started. We took it to Axel. They were kind enough to fund it. And actually, Scripbox was a division of Probe to begin with for the first 1 year. And then he spun it off and it's become different and bigger probably. that's the journey. So partly sort of the age thing was both a challenge and a benefit. Challenge because obviously the youngsters have a lot more energy and a lot more drive and a lot more raw ambition. But the benefit was that you came with a lot more sagacity, you came with a lot more patience, you came with a lot more corporate governance, you came with a lot more gravitas and sort of at least how to run a business, how to build a business. That was one. The other was that relatively you had some financial cushion. So you were not in the short termism of anything, right? You knew that there was food on the table and your family would not, and that's always a challenge for some of the entrepreneurs at a younger age, right? Especially if you're 30, 32 and you just got married. At that time, this is a much more complex journey, income, family, etc. So I think those are the advantages of being a slightly late stage entrepreneur, that you had a bit of financial cushion, but you still needed to do well and you could do it well.
Atul, this show is all about creating ripples of inspiration. So, in closing, if you were to share your Inspire Someone Today message to all the listeners, what would that be?
If you're an entrepreneur or planning to be one, courage and conviction. Believe in yourself, go for it hard, have fun doing it. And like my father once said, if not you, who? If not now, when? He said, God is kind to you guys. You are privileged with good education, some capital. So if you're not creating employment for others, then maybe you're missing out. So the inspiration is to do more for the country. The inspiration is to make an impact. We're very proud of the fact that the other company, Pro, more than, say, 1,000 families are impacted by what we do there in terms of providing employment. And there's a multiplier effect, right? If you've got 1,000 families directly impacted, 5,000 people, they will impact so many more. So, yeah, beyond the success of your own company and the metrics and the unicorn status, etc., it's the larger impact you're having, which is important. So, if you're sitting on the fence, go for it now. Go for it now.
If you're sitting on the fence, go for it. On that note, Atul, thank you so much for sharing your insights, words of wisdom. Definitely a great framework for all the listeners on their investing horizon. Thank you for listening into today's edition of Inspire Someone Today. It's been a privilege to bring in these conversations. If you like this episode and have any feedback or comments, do mail me at inspiresomeonetodaypodcast@gmail.com. Inspiring someone is like creating ripples around us. If you like what you listen, feel free to share them and let's create ripples of inspiration. Do not forget to follow me on my Instagram handle @InspireSomeoneTodayPodcast for all the latest updates. This is Srikanth, your host, signing off, and until next time, keep inspiring.